So let's first take a more detailed look at the acquisition method when dissolution takes place. The acquisition method when dissolution takes place, as we said that we make a journal entry on firm A's book, which basically move firm B's assets and liability from A's book, and then we close off firm B's book. So specifically, there's three kinds of situations. Either, so at the date of acquisition, firm A is giving out something to acquire firm B, and whatever firm A gives out, that is called the consideration transferred. So the three situations are either consideration transferred will be equal to the fair value of firm B's net asset, or the consideration transfer would be higher than the fair value of firm B's net asset. A is giving more to acquire B. All consideration transfer is smaller than the fair value of firm B's net asset. So A is giving less to acquire B. In the first situation, basically we debit acquiree's asset at fair value. So we debit firm B's asset at fair value of those assets. We credit firm B's liability at the fair value of those liabilities. And then we credit the consideration transferred by firm A at its fair value. So this is the first kind of situation. The second kind of situation, what if we're paying more to acquire firm, what if firm A is paying more to acquire firm B? So in this situation, there will be this journal entry with not balance. And where would be the imbalance be? Would it at the debit side or the credit side? So if the consideration transferred is higher than the book value of firm B's net asset, the difference will be at the debit side. And in this situation, the difference, we are going to record it as goodwill. So it will be at the debit side. And in the third kind of situation, if we are giving less, in this situation, again, this journal entry would not balance. So, and the imbalance will be at which side? Please take 1 minute to think about it. So if we are paying less, the difference will be at the credit side, right? And then this difference will be recorded as gain on bargain purchase. So here's a question I want you to take 1 minute to think about. Do you notice there's some asymmetric treatment here? In situation 2, when we are paying more to acquire the net to acquire firm B, the difference is recorded as a goodwill, and goodwill is an asset account. So actually, if it is in this kind of situation, the more that we paid, that additional money, it is not recorded as an expense for us. It doesn't impact our income statement in the current period. Instead, it gets to be landed on our balance sheet. So we can take care of it later, but we don't need to worry about it impacting our income statement in the current period. However, in the third situation, when we are paying less to acquire firm B, what we do is it is like the bargain we get, it can be recognized immediately as a gain for us. So it gets to increase our bottom line earnings for the current period. So please take 1 minute, think about it. Why can we allow this as what is the logic here for this asymmetric treatment? So what is the logic here for this asymmetric treatment? The reasoning here is, if it is in the second situation, if we are paying more to acquire the fair value of firm B's net asset, we view the difference as something that may bring us some future benefit. So that's why we would allow it to be recorded as an asset, which can bring us future, the definition of an asset is something that can bring us future economic benefit, right? So that's why we would allow it to be recorded as an asset on our balance sheet. It doesn't need to be expensed immediately. However, in the second situation, if we are paying less than the fair value of the firm to acquire it, please think about what we can do. So you can turn around to sell it immediately at its fair value, right? So if the fair value of firm B is 10 million and you are using 8 million to acquire it, what can you do? What is the fair value? Fair value is a price that everyone would accept in an ordinary transaction that everyone would accept. And then what you can do in this kind of situation is you paid 8 million, but the fair value is 10 million. So you can turn around immediately to sell it on the market for 10 million. So that will bring you an immediately benefit. You are immediately better off by taking up this transaction. So that's why that in the second situation, the difference can be recorded as gain on bargain purchase. It can, we allow it to increase our bottom line earning in the current period immediately. So let's actually look at some examples that corresponding to these three situations. The example is, so we have big net and small pot, and we have big net book value at the end of the year. We have small pot's book value at the end of the year. We also have small pot's fair value it is at the end of the year. So we have the firm's big net's book value at the end of the year, small pot's book value and fair value at the end of the year. And then big net in the first situation, big net pays 2.55 million to acquire all of small pot's asset and liability. Specifically, what does big net pay? So this 2.55 million is made up of cash of 0.55 million, 20,000 unissued shares of 10 par value that is currently selling for 100 per share. So this will give us 20,000 multiplied by 100, that is 2 million. So that is how this 2.55 million is made up of. Small pot then dissolve itself as a legal entity. So small pot dissolve, and then the only surviving firm is big net. What is big net's journal entry to record the acquisition? Please try to work on it on your own. Please take 5 minutes and pause your video for now. So what is big net's journal entry to record this acquisition? Basically, under the situation of dissolution, one or more firms dissolve, there's only one surviving firm. We need to move all of the dissolving firms' assets and liability physically to the surviving firm's balance sheet. So what we do is we debit all of small pots asset at the fair value of those assets. Specifically, what are those assets? So those assets are, the small pot has current asset, 300,000 fair value. Computer and equipment, 600,000 fair value. Capitalized software, 1.2 million, that is the fair value. Customer contract, even though on the book value is 0 because it's an intangible, but the fair value is 700,000. So actually, this is the time that usually for intangibles like customer contract, we cannot recognize the value of those. But in the situation of acquisition, the firm is able to revalue those intangibles at its fair value. So we can record it, customer contract at its fair value, which is 700,000. And then we credit small pots liabilities at the fair value of those liabilities. Specifically, what liabilities does small pots have? Small pot has notes payable. The fair value of notes payable is 250,000. So we credit 250,000. which is the fair value of small parts, notes payable. And at the same time, we credit consideration transferred at the fair value of the consideration transfer. Specifically, what are the consideration transferred from BigNet to small part? So BigNet paid cash 550,000, and also is giving out 20,000 shares of common stock. So we credit common stock. The par value is 20,000 multiplied by 10, so that's 200,000. And additional paid-in capital is 20,000 multiplied by 90, so that's 1.8 million. So basically, BigNet's journal entry is as follows, as we just explained. So these are small parts asset. This is small parts liability, and this part is the consideration transferred from BigNet to small part. So this is the first situation. And then here is a second situation. Supposedly, so everything is the same as before. The only difference is now BigNet is paying a little bit more to acquire small part. So BigNet pays cash 1 million, and then it also pays 20,000 unissued shares of 10 par value 100 per share. Small part dissolve. And what is BigNet's journal entry to record the acquisition? Please take 5 minutes, work on this example, and please pause your video for now. So in this situation, almost everything is the same as before. The only difference is BigNet is paying more. So we still do the same thing as before. We debit all of small parts asset at the fair value of those assets. And we credit, so this is small parts liability at the fair value of the liability. And we credit the consideration transferred at its fair value. So specifically, the consideration transferred from BigNet to small part, it is 1 million cash. Common stock, 20,000 shares multiplied by $10 per share. So that gives us 200,000. Additional paid-in capital, that is 20,000 shares multiplied by 100 minus 10. So this is 1.8 million. And then now this journal entry does not balance because BigNet is paying more. So the unbalance will be at the debit side. And then we call the difference goodwill. So the amount of goodwill is 450,000. And this is the journal entry for the second situation. And now let's look at a third situation. Under the third situation, now BigNet is paying less. So specifically, BigNet now is paying no cash. The only thing BigNet is paying a stock. It is a 100% stock acquisition. And then small part dissolve as a legal entity. Please take 5 minutes. Try to work the journal entry on your own. And please pause your video for now. So in this situation, in the third situation, almost everything is the same as before. So we debit small parts asset at the fair value of those assets. And we credit small parts liability at the fair value of those liabilities. We also credit the consideration transferred from big net to small pot at its fair value. So specifically, we have no cash transfer this time. So we only credit common stock and additional paid-in capital. And now this journal entry is not going to balance. The imbalance will be at the credit side because now big net is paying less than the fair value of small pot's net asset. And the difference, which is 550,000, it will be at the credit side, and it is called gain on bargain purchase. So this is the journal entry for the third situation. And if you compare among these three situations, all of them are the situation when dissolution occurs, when dissolution takes place. You can see that in all of these situations, we debit small pot's asset at its fair value, and we credit small pot's liability at its fair value. And the consideration transferred, depending on how much we transfer, we credit consideration transferred at its fair value. And then the indifference, if there's no indifference, which is the first situation, we don't need to do anything. If the indifference is at the debit side, we debit it as goodwill. If the indifference is at the credit side, we credit it as gain on bargain purchase. So we talked about the three situations when dissolution takes place. Now there's a last thing I want you to do. Let's take out the second situation in this when dissolution takes place. Actually, it also applies for the first situation, the third situation, but just for it to for the ease of illustration, we just take out situation 2. You can work out situation 1, situation 3 on your own. So let's take situation 2. I want you to take 5 minutes, try to work on what is Big Net's financial statement right after the acquisition. So Big Net has a financial statement. We have Big Net's financial statement before acquisition, right? So it is this column. And then we make a journal entry, which we just talked about. Please just combine this column with the journal entry and tell me what is Big Net's financial statement after the acquisition. So the reason we are working on this is we are going to use this last column to compare it with the other dissolution situation later when we get there. But please first just take situation 2 and work out Big Net's financial statement after the acquisition. So take 5 minutes and you can pause your video for now. So in the dissolution situation, this column is actually the same as what you saw on your PowerPoint. We have Big Net's book value, and then we have small pot's book value and fair value. And the journal entry, so if it is when Big Net is paying more to acquire small pot, Big Net's journal entry at acquisition is, it is going to move all of small pot's asset and liability to its book and to record them at their fair value. So specifically the journal entry, this is just to repeat what we just said. Big Net is going to debit it is going to debit current asset for 300,000. Debit computer and equipment for 600,000. Debit capitalized software for 1.2 million. And debit customer contract for 700,000. And it is going to, at the same time, it is going to credit notes payable for 250,000. So this is to move small pot's asset and liability to its book. At the same time, BigNet is going to credit the consideration transferred at its fair value. So specifically, the consideration transferred by BigNet to Small Pot, BigNet paid cash of 1 million. So this will give us a net number of 700,000 decrease in current asset. And it is paying common stock in the amount of 200,000. Additional capital, 1.8 million. And then also the indifference will be at the debit side. So we record it as goodwill. So, and this journal entry, all of the debit and credit will balance. So this is BigNet's journal entry at acquisition. And BigNet's financial statement after acquisition, basically we have column 1 here. And if this is column 2, so the last column is 1 plus 2, column 1 plus column 2. So we just move everything to the last column, and we just try to add column 1 and 2, and that is our last column. So revenue is going to be 1 million. Expense is 800,000, and net income is revenue. So for net income, we do it vertically. We take revenue, the consolidated revenue minus the consolidated expense, and that will give us 200,000. And for this 200,000 revenue, we carried over to the statement of retained earning. On the statement of retained earning, the beginning retained earning is column 1 plus column 2, so that is 870,000. Dividend is 1 plus 2, so that's 110,000. And retained earning at the end of the period, we don't do it horizontally. Instead, we do it vertically. So that will give us 960,000. And we carry this number over to our balance sheet. On the balance sheet, the current asset is 1.1 million minus 700,000, so that's 400,000. Investment account was never involved here, so we have never done anything regarding the investment account. So this investment account is 0. Computer and equipment is 1.3 million plus 600,000, so that gives us 1.9 million. Capitalized software, 500,000 plus 1.2 million, so that's 1.7 million. Customer contract, that's 0 plus 700,000, so 700,000. Goodwill is 450,000. And then if you add them all together, you are going to get total asset of 5.15 million. For notes payable, we have 300,000 plus 250,000, so that's 550,000. Common stock, if you add up everything, that will give you 1.8 million. Additional capital, if you add up everything, 1.84 million. And then if you add up everything on your right-hand side of the balance sheet, that will give you 5.15 million. And this number should be exactly the same. Those two numbers should be exactly the same. Your balance sheet should balance. So this is BigNet's resulting financial statement after acquisition. And this column is the number that BigNet is going to report to its investors after acquisition. So the solution, please refer to handout 1. So I'm going to post it on Island. And this is what I want to talk about regarding the situation when dissolution takes place and there's only one surviving firm. And then we are going to look at the other situation when there's no dissolution and both firms survive.